Article 43. Charging tax based on profit margin. Article 43 of the UAE VAT Decree Law provides that a taxable person, registrant, may elect to calculate and charge value-added tax, VAT, based on the profit margin earned from certain taxable supplies rather than on the full value of those supplies. This article provides flexibility to businesses in specific scenarios, allowing them to adopt a profit margin-based taxation method if certain conditions and requirements are met. 1. Option to calculate VAT based on profit margin. A registrant, meaning a person or entity registered for VAT purposes, is permitted to calculate VAT using the profit margin method for specified taxable supplies. This is an optional method, meaning the registrant can choose to apply it for any tax period if eligible. Instead of applying VAT to the full value of the goods or services being supplied, VAT is applied only to the profit margin earned by the supplier on those goods or services. 2. Applicability limited to specific supplies. Not all types of supplies are eligible for this method, and the executive regulation of the decree law specifies the categories of supplies that may qualify for the profit margin scheme. Common examples include second-hand goods, antiques, and collector's items, where the goods have already been subject to VAT when originally purchased, and applying VAT on the full value again would lead to double taxation. 3. Requirement to notify the Federal Tax Authority. If a registrant decides to adopt the profit margin scheme for any tax period, they are required to formally notify the Federal Tax Authority, FTA, about this decision. This notification ensures that the FTA is aware that the registrant is applying VAT on the profit margin instead of the full value of supply. Failure to notify the FTA could result in non-compliance penalties and the denial of the right to apply the scheme. 4. Specific conditions and requirements. The executive regulation provides the detailed conditions and controls for using the profit margin method. These conditions typically include identifying the type of goods or services eligible for the scheme and providing proof that the goods have already been subject to VAT at some point, such as when previously sold to a consumer. They also require maintaining documentary evidence showing the original purchase price and the resale price for the purpose of calculating the profit margin. In addition, correct invoicing practices must be followed so that the VAT-inclusive price reflects tax only on the profit margin. 5. Benefits of profit margin scheme. This scheme is designed to simplify VAT compliance for businesses that deal in second-hand goods and similar items. It avoids double taxation, ensuring VAT is only applied to the value added, profit earned, by the seller, rather than taxing the entire resale value again. The scheme also helps maintain fair pricing in markets such as used car sales, second-hand electronics, and resale of pre-owned luxury items. 6. Compliance obligation. Businesses opting for the profit margin scheme must ensure they maintain complete and accurate records to demonstrate eligibility. Correctly calculate the profit margin for each supply. Issue invoices in line with the requirements of the scheme. Notify the FTA as required, and apply the scheme consistently across all eligible supplies in the relevant period. For more details, contact us.